So it's time now to turn our attention to cost curves, which will be useful for us as we move forward to talk about different market structures like competition and monopoly. But before we dive into deriving the cost curves, I just want to remind you a little bit from intro about which costs we're interested in calculating. So first is to think about total cost, the total cost of production, which of course is going to be equal to all of your fixed costs plus all of your variable costs. In the context of our production functions that we've just learned, we're going to think of our fixed costs as costs associated with capital and our variable costs as costs associated with labor, since we're assuming that capital is fixed in the short run. And we are going to have some production function that describes how we turn inputs into outputs. And based on that production function and the cost of our inputs, we will also get a corresponding cost function. So let's just take a minute to think about the relationship between the production function and the cost function. So here on the graph, I have a production function, and you can see that at first, my output is increasing at an increasing rate, which tells me that the marginal product of labor here, labor is on the x-axis, the marginal product of labor is increasing on this portion of the cost function, because see, every unit of labor I add is going to add a bit more output, so my marginal product is increasing. After we cross this dotted line, the opposite is true, and it starts to level off here. So on this portion of the production function, we have decreasing marginal product. In other words, every unit of labor that we add is leading to a little bit smaller output than the output gains than the last unit of labor. So how does this thinking about marginal product, the slope of the production function, translate into thinking about cost? Well, each unit of labor costs something. It costs the wage. So if I say that each unit of labor produces more output, then that's the same as decreasing the cost per unit of output. So on portions of the production function where we have increasing marginal product, we would have decreasing marginal cost. And if we were to plot our cost function, then it's going to look something like this. Of course, cost is increasing with output, but here you can see it's increasing at a decreasing rate. So again, that's because if my marginal product is increasing, each unit of labor produces more output than the last. Then as I increase output, the cost for each additional unit of output is decreasing. So I have a decrease in marginal cost. Notice here I have Q on the x-axis rather than L, because I'm thinking in my cost function about what happens to my cost as I increase my output. Now, once I cross this dotted line, remember the opposite is true. We have a decrease in marginal product, or each unit of labor is becoming less and less productive, meaning that if I want to produce one more unit of output, I'm going to need more and more labor to get there. So in this case, our decreasing marginal product will mean increasing marginal cost. And what does that look like on our total cost function? It looks like a slope that's increasing at an increasing rate. All right, so hopefully we've made this leap from talking about marginal product to talking about marginal cost. Remember that when we're thinking about cost functions, we always want to think about them in per unit terms, okay? So quantity is going to be on that x-axis as we think about changes in cost as production changes. And I'll remind you now that total cost is not the only cost that we're thinking about. We've already mentioned marginal cost is important, but I want you to recall from your intro class that there are a couple other types of costs that we can calculate to help us better understand a firm's behavior based on the cost functions relative to the firm's revenue. I find it helpful to think about the questions that we're trying to answer using each of our cost concepts. So first, what quantity should the firm produce to maximize profit? Recall that profit is total revenue minus total cost. And we want to earn money. We want to produce as long as our revenues are greater than our costs. And at the margin, that means that we'll continue to produce as long as marginal revenue is greater than or equal to marginal cost. In other words, the revenue from each additional sale is greater than the cost of producing that unit of output. So our marginal cost we would calculate as the derivative of total cost with respect to quantity. It's the additional cost for each additional unit of output. The next question is, will the firm earn positive or negative profit? And this is going to be determined by comparing per unit revenue to per unit cost, which we call average total cost. So remember that profit is equal to, one of our equations that we use in intro is price minus average total cost times quantity. So if your revenue per unit, your price, is greater than your cost per unit, then profits will be positive. And average total cost is equal to total cost over quantity. Again, it's the per unit cost. The last cost concept that we cover in intro typically is average variable cost, which helps us think about the firm's short-run shutdown decision. Recall that your fixed cost is like a sunk cost. In the short run, you can't get it back, even if you choose to shut down or say, I'm closed on Saturday. What you can do is decide whether or not it's better to close on Saturday or to open. And generally, you're making that choice when your profits are negative. So even when profits are negative, you might still choose to open or produce some positive quantity in the short term, right, on 1 day a week, say, as long as your revenue per unit is greater than or equal to your average variable cost. So average variable cost is your variable cost per unit. And the reason why we're comparing that to revenue is that that's like your operating cost. Excluding the fixed cost, the sunk cost, we want to produce as long as the revenue of each unit is greater than the operating cost per unit or the variable cost per unit. Okay, so in this class, we're going to sort of ignore average variable cost for now. We just don't have time to cover everything. But we are going to focus primarily on marginal cost and average total cost, along, of course, with our total cost curve. So let me remind you what they would look like in intro or analogously for this total cost curve that we've drawn up here, right? For this total cost curve, at first, we have a segment where the marginal cost is decreasing, and then we have a segment where the marginal cost is increasing. And this is the typical way that we drew your marginal cost curve in intro econ, right? Here's that dotted line where we made the switch from increasing marginal product to decreasing marginal product. And then your average total cost curve would intersect marginal cost somewhere up here. And that point where they intersect is pretty important. It's actually the minimum of the average total cost curve. So remember when we talked about marginal product and average product, and how the relationship between the marginal and average functions dictates that as long as your marginal function is below the average function, your average function will be decreasing, right? Like, so if you think about GPA, for example, like your GPA is the average of your grades in all of your classes. Your marginal grade, that would be the grade from one more class, right? So if you take one more class and you get a lower grade than your average, it's going to bring the average down. And likewise, if you get a higher grade than average, it's going to bring that average up. So here you can see, like, when marginal cost is below average total cost is decreasing. When marginal cost is above average total cost, average cost is increasing. So the consequence is that the average function intersects the marginal function at its minimum. And that was the zero profit point, the competitive long-run equilibrium in your intro classes, and we'll talk about it some more as we go through today. Now, I want you to understand that these cost curves, they're the way that we drew them in intro, and maybe they're a little more realistic, but they're actually pretty complicated mathematical functions, as you might guess from the graphs. So we're going to proceed using some simpler functions to work with, and hopefully that's good news for you.